In this video, we're going to look at another balance sheet adjustment, bad debts and allowance for doubtful debts. So, what is it all about? Now let's imagine the balance sheet shows an accounts receivable amount of $10,000. As a business, you'd be expecting a cash inflow of $10,000 from collecting debts from the accounts receivable. Or so you'd hope. The real question is, can you really collect all $10,000? In reality, bad debts are common, and not all the time will we be successful in collecting debts in full. Here are links to a couple of qualitative characteristics. The first one, faithful representation, which states that financial information should be complete and faithfully represents real-world economic events it claims to represent. Recognizing bad debts expense, as well as allowance for doubtful debts, which is a negative asset, allows more accurate reflection of the recoverable amount from the accounts receivable reported in the balance sheet and expense and profit reported in the income statement. The other qualitative characteristic is relevance, which states that financial information should be capable of making a difference to decision-making by users. The first part of the link is the same as what was mentioned for faithful representation. However, we'll need to link our explanation back to decision-making, which is what relevance is all about. Now, with better and more accurate reflection of the accounts receivable position in the balance sheet, as well as the expense and profits in the income statement, this enables better decision-making. For example, making decisions relevant to management of the accounts receivable and collection of debts. Here are some of the terms that will be used in this chapter that you should be aware of. Firstly, doubtful debts. They are basically the accounts receivable debts that are unlikely to be collected, not yet written off, not yet confirmed that the accounts receivable cannot pay the debt owed. Basically, they are the debts that maybe, possibly, cannot be recovered. Next, bad debts. Bad debts are basically recognized as an expense incurred when the allowance for doubtful debts is recorded or adjusted for the period. The last one is bad debts written off, which is different to bad debts expense explained just before. Bad debts written off are confirmed unrecoverable amounts from the accounts receivable, which is probably due to situations such as bankruptcy or liquidation of the accounts receivables business. Bad debts written off are amounts written off from the accounts receivable. Bad debts written off are definitely, surely, certainly amounts that cannot be recovered. Now we're going to look at the entries. The first one would be relating to allowance for doubtful debts that are being calculated, recorded, and reported for the first time. When calculating allowance for doubtful debts, we are using the income statement approach, which is to estimate certain percentage of net credit sales in the period that is likely to be uncollectible. Here's an example. We can see that we've been given the accounts receivable balance as at 30th of September. We are also given the sales and sales returns amounts for the period. In the additional information, we are told that data from previous years suggest that 2% of net credit sales will be doubtful of collection. So for calculating the allowance for doubtful debts, we'll need the 2% as well as the net credit sales. It is important to remember that net credit sales is calculated by taking the sales less sales returns. Also, we must remember that the net credit sales must exclude GST. Here's the calculation of doubtful debts. We take the estimated rate of 2% multiply by the net credit sales, which is the sales of $120,000 less the sales returns of $3,000. The doubtful debts amount that we got is $2,340. As you will remember from earlier, bad debts is an expense that is recognized as incurred in the period when we are recording the allowance for doubtful debts, which is what's happening here with this general journal. Bad debts is an expense that has a debit nature and is increasing as it is recognized as expense for the period. That is why we are recording the amount on the debit side. And this amount of $2,340 was basically the allowance for doubtful debts that has been calculated just before. And on the credit side, we record against the account allowance for doubtful debts, which is basically a negative asset and therefore having a credit nature and an increase for this period. This is how the entry will look like in the general ledger account. In the bad debts expense account, we can see that we have recorded on the debit side an amount of $2,340 with a cross-reference to allowance for doubtful debts. And in the allowance for doubtful debts account, we can see the amount of $2,340 on the credit side with a cross-reference bad debts. You may also be asked to identify or explain the effects on the accounting equation or the balance sheet, which is the same thing. When bad debts expense is recognized, expenses increase by $2,340 and therefore decreasing profits. Overall, owner's equity decreases by $2,340. On the other hand, when allowance for doubtful debts is recognized, it increases by $2,340. And because allowance for doubtful debts is a negative asset, overall, current assets decrease by $2,340. Here we can see how allowance for doubtful debts and bad debts are reported in the financial reports. Let's start with allowance for doubtful debts. In the balance sheet, under the current assets and under accounts receivable, we report less allowance for doubtful debts. What we're trying to say here is that out of the $65,000 accounts receivable balance, $2,340 are doubtful debts, which are debts that maybe, possibly cannot be recovered, leaving us with a balance of $62,660 accounts receivable balance that are more likely able to be collected. On the other hand, in the income statement, we report the bad debts amount, which is the bad debts expense that is recognized as incurred in this period. In this next section, we're going to look at how we record for bad debts written off, which are debts that are basically confirmed unrecoverable from the accounts receivable. When we are sure that the accounts receivable can no longer repay the amount owed, we therefore need to write off this amount from the accounts receivable. Here's an example. On the 16th of October, GOR Gullible received notifications that an accounts receivable can't pay has been declared bankrupt and will no longer be able to repay the amount owing $1,650. Therefore, we will need to write off the amount owing as bad debt. When recording in the general journals, I find it easiest to start the analysis with the accounts receivable account. We know that the accounts receivable is an asset which has a debit nature, and because we are writing off the amount owed by the accounts receivable, we are therefore recognizing that the accounts receivable balance is going down, and that is why we record the amount of $1,650 on the credit side. Next, we need to record the GST adjustment. When the sale was first made to the customer or the accounts receivable can't pay, the sale would have included GST, and therefore the amount owed by the customer or the accounts receivable would include GST. On this basis, we know that the amount of $1,650, which was the amounts owed that we are writing off as bad debt, would include GST. To calculate the GST, we take $1,650 divided by 11, and that would give us a GST amount of $150. Now we know that the accounts receivable can no longer repay the business for the amount owing $1,650, and this amount represents the original sale that was made to this accounts receivable, which included a GST of $150. When we are writing off bad debts with this general journal, it is as if we are reversing the original sale. Therefore, the GST liability that we would have recognized when the sale happened is now being reversed. Therefore, the GST liability is decreasing, and that is why we record the GST adjustment of $150 on the debit side. To finish off this general journal, we need to record the bad debts written off amount against the account allowance for doubtful debts. The reason we are writing off the bad debts written off amount against this account is because we have already previously allowed for possible bad debts to happen. And therefore, all we're doing here is to reduce the allowance that we have made. As you would hopefully remember, allowance for doubtful debts is a negative asset, which has a credit nature. And because we are reducing the allowance that was previously made, we are recording the amount of $1,500 on the debit side. And you would also see, using your general journal knowledge, that to get this general journal to balance, we take $1,650 on the credit side, less $150 GST on the debit side, and that would leave us with $1,500 to be recorded on the debit side. Lastly, we're going to look at adjusting allowance for doubtful debts balance, and this happens at the end of a period. In step 1, we were calculating and recording the allowance for doubtful debts for the first time on the 30th of September. Now in our new period of October, we are doing this calculation again on the 31st of October. And to do this, we apply 2% to the net credit sales for the month of October. And here in our calculation, we can see that our allowance for doubtful debts as at 31st of October is $2,460. Now let us have a look at the bigger picture and see how the allowance for doubtful debts has changed over the month of October. So if you remember in step 1, on the 30th of September, we calculated and recorded the allowance for doubtful debts of $2,340 for the first time. In step 2, we were told on the 16th of October that an accounts receivable has been declared bankrupt, and it is confirmed that the debt can no longer be recovered. If you remember from the entries, we have reduced $1,500 from the allowance for doubtful debts on the 16th of October. This leaves us with an amount of $840 in the allowance for doubtful debts at this point. In step 3, which is the step that we're in right now, we have just calculated the balance of allowance for doubtful debts as at 31st of October by taking 2% multiplied by the net credit sales for the month of October. And this has given us an allowance for doubtful debts amount of $2,460. So on the 16th of October, we are left with an allowance for doubtful debts balance of $840. But based on our calculations on the 31st of October, we need our balance to increase to $2,460. This is an increase of $1,620. The question is, how do we record this increase? Perhaps you might have remembered this, that when we are recording an adjustment to the allowance for doubtful debts, we are recording it against the bad debts account, which is an expense that is recognized as incurred in the period. This is how we record the adjustments to the allowance for doubtful debts using the general journals. The allowance for doubtful debts is a negative asset and therefore has a credit nature. As we have worked out, there is an increase to the allowance for doubtful debts by the amount of $1,620, and that is why this is recorded on the credit side. As we have established, any adjustments to the allowance for doubtful debts is recorded against the bad debts account, which is an expense that has a debit nature. And because we are recognizing this as an expense that has incurred in the period, we are debiting the account $1,620. I find it useful to also look at the allowance for doubtful debts ledger account to help us work out the movements over the period, which would help us work out the adjustments that we'll need to make to the allowance for doubtful debts at the end of the period. So let's have a look at this as an example. On the 30th of September, that was when we recorded the allowance for doubtful debts for the first time, and the entry was a credit of $2,340 to the allowance for doubtful debts, and the other side of the entry was a debit to the bad debts expense account, which is reflected here in the cross-reference. When we completed the balancing process, we would have a closing balance of $2,340 on the 30th of September, and that would also be the opening balance on the 1st of October. Then on the 16th of October, we recorded bad debts written off, and the entry was a debit of $1,500 to the allowance for doubtful debts account, and the other side of the entry was a credit to the accounts receivable, which is reflected here in the cross-reference. On the 31st of October, we calculated the new balance of the allowance for doubtful debts, and that was $2,460. This is the amount that we want as a closing balance in our allowance for doubtful debts account, which would also form the opening balance on the 1st of November. As we complete the balancing on the 31st of October, we can see that we will have a missing figure on the credit side of the allowance for doubtful debts account. This is basically the adjustment to the balance that is recorded against the bad debts expense account. And you can see here that this is an adjustment of $1,620 that is credited to the allowance for doubtful debts. And on the other side of the entry, it would be a debit to the bad debts expense account, which is reflected here in the cross-reference. Now let us have a look and see how allowance for doubtful debts and bad debts are reported in the financial reports. In the balance sheet, as at 31st of October, under current assets and under accounts receivable, we report less allowance for doubtful debts, and the amount is $2,460. This was the amount that was calculated on the 31st of October by taking 2% multiplied by the net credit sales of $123,000 for the month of October. We can also see in the balance sheet that out of the balance of $72,000 in the accounts receivable, we are expecting to only recover $69,540. In the income statement for the period ended 31st of October, in other words, in the month of October, we report under other expenses the bad debts expense of $1,620. This amount is basically the adjustments that we have made to the allowance for doubtful debts account on the 31st of October. So what next? I find it useful to have a look at the summary of the cycle to understand how this happens from month to month or from period to period. We start off by calculating and recording allowance for doubtful debts for the first time. Whenever there are bad debts written off, we record them to reduce the allowance for doubtful debts. At the end of the subsequent period, we recalculate and record adjustments to the allowance for doubtful debts balance. The cycle continues as we record bad debts written off, as well as calculate and record adjustments to the allowance for doubtful debts at the end of subsequent periods.